My goodness gracious. All right, so here's all of the different things we're seeing right now in regards to the news articles, and this was today. I mean, there's so many. So what I'm going to do is I'm going to show you a really great chart that's going to illustrate the changes. If it's in red, that's a change for the worse, so higher prices. If it's green, that means it got better. So I'm going to go over this chart, and these are now loan level adjustments are the cost of rates, the adjustment in the cost in points for that rate. All right, so I'm gonna jump into this real fast. I'm gonna show you kind of what's going on right here. Hold on one second while I move this over here. So this right here, this red, these are all the higher costs. Okay, if it's yellow, that means there's not really much of a change. If it's red, that's the higher cost. So what I want to show you is if you go over to the left-hand column and you see the credit scores on the far left, you're going to see that if you're in the bucket of a 680 credit score and up to 779, you're going to be in this square right here, which means things are getting worse for you. So if you were trying to buy a home and you're putting 10, 15, 20% down, you now have to pay a half a discount point or 3/8 of a discount point, or even 3/4 right here with 15% down, 3/4 of a discount point more in fees to get that same rate. Or you raise the rate to absorb it. So to absorb a cost of 0.75 in points, it's about every eighth in rate costs about a 1/4 discount point to get. So if you wanted to buy the rate down an eighth, it costs about a 1/4 discount point. So now we're talking right here, 3/8 in rate to absorb this cost. So if you had a rate at 6.5, now congratulations, you now have 6.875, and rates haven't changed. It's just because of these loan level adjustments. Now look at, they're using all of these gains right here to make it cheaper on the people down here that have less down and have lower credit scores. Now, let me explain to you. And I'm going to see if I can show you this in a little bit better of an image. Hold on one second. I'm going to put my picture on here so you can see this. Okay, so right now, the good buyer right here, the price of their mortgages was way up here. The bad borrower was right here. It's done this. So I want to be clear and watch this. This is a really good visual aid. The price, if you have really good credit, was a lot better. Your rate was a lot better. Now we're just moving it down. So the rates are still better if you have a higher credit score and better down payment. They're just not as good as they were. I hope that makes sense. So, but what we're doing is we're basically subsidizing these right here, because like it's now 1 3/4 better in pricing for somebody with a credit score of 639 or lower with 5% down. It's that much cheaper. So that's probably a half to 0.65 in rate, maybe 0.75 in rate better for this person down here, and then a half worse or better or worse for the buyer who has a better credit score in this bucket. So as you can see, it's more expensive for this borrower today than for this borrower. They are now getting subsidized. So all of this green are their rates are getting better, and all of the red is their rates are getting worse. And this is, as of right now, it's being instilled on any loan that is being guaranteed by Fannie Mae and Freddie Mac as of May 1st. Is it fair? No, it isn't. I guess it depends on what side of the fence you're on. Before, it was a huge drastic difference between a borrower with a 760 credit score and a 639 credit score when you did a conventional loan. Now that difference is narrowing. So you still get a better rate if you have a higher credit score, but that gap is shrinking and we're paying for it basically up here. But yeah, if you were to take a rate from a month ago and a rate of what's going to happen now, And without seeing any other changes in the market, rates are going to be about 3/8 to a half higher for that borrower. So let's go over some of the some basics here. There's now a new credit score band. Now, when I mean my band, I'm going to go back to this. If you had a 760 credit score or higher, the rates were the same for everybody in the past. Okay, so if you had a 760 credit score or higher, everyone had the same credit score. Now there's a new bucket. I'm going to go back to this. This 760 to 779, you now have a pricing hit. So you get a worse rate. And there's also one above 70, 780. You get a worse rate here. So there used to not be anything above 760. Now they added a couple tiers. So to get no adjustments at all, you have to be above 780 and putting 10% down. If you want to put a little bit more down, you're going to get an adjustment. But look at this. It's a little bit better right here. If it's a little bit better if you have a 780. So they're actually giving you a little bit of a break now at that 780, whereas before there wasn't one. So some pros, some cons, but for the most part, we're seeing basically higher rates for anyone in that bucket that has a 680 to 740 credit score. Now, there is more differentiation in high balance versus non-high balance. So that's a whole nother conversation we could talk about. There's several changes also to 2 to 4 unit property loan level pricing adjustments. So this is just one, that one screen I showed you guys is just a standard primary home purchase. There's cash out adjustments. There's huge increases in doing cash out loans now if you have decent credit scores. It's kind of a mess. And to be perfectly candid, the mortgage industry is pissed. I mean, they are, and borrowers are as well. It's all about expectations, right? If you're expecting to get a certain rate, and now for no reason other than, well, there's no reason really about it going up other than trying to subsidize, right? So we're all getting punished for those buyers that are in that bucket. Now, if you're in a lower bucket, you're probably like, yay, that's gonna be great. But guess what, guys? If you have a 620 credit score, or 640 credit score, or 660 for that matter, and you're putting low amount of money down, you're not gonna get a conventional loan. So all of those adjustments that they're giving, those are never gonna really come through. They're not gonna get those because those borrowers will get a much better deal on an FHA loan, much better. So I'm curious to see how many loans will actually close in that bucket in a conventional loan in the next 6 months compared to what FHA does in that bucket. You'll be surprised. So it mainly is going to hurt the good people, unfortunately. So here's simply put, this is just my opinions. Conventional mortgage rates are still better for those that have good credit compared to those who don't have good credit. The savings comparison, the gap is just smaller between somebody that has really good credit and really bad credit for a conventional loan. There used to be a huge disparity in rate. You might be 6.25 with 10% down with a 780 credit score, and your rate might have been 7.875 if you had a 620 credit score on conventional with the same 10% down. Now that gap is shrinking, and we're subsidizing it to make that happen. So I think still FHA, if you are looking for a borrower who has a lower credit score and lower down payment, FHA is still awesome. One of the best things about FHA lately is they lowered their monthly mortgage insurance from 0.85% to 0.55% for the most part. If you're doing 3.5% down, putting a low down payment, they lowered it by 30 basis points. So conventional is trying to keep up, so to speak, but FHA is a much better option for those people. So all of these adjustments they're making to make it more expensive for the higher credit score borrower are not going to really pan out too much because those lower credit score borrowers will get an FHA loan anyhow. So really, it's just a tax for those with higher credit scores. I look at it as another money grab. It's frustrating. It really is frustrating. So let's shift topics to see what's going on in mortgage rates. We had a good run a little while back where the mortgage-backed securities went up, and when mortgage-backed securities goes up, we all win. So that means lower mortgage rates. So this last week, we saw a little bit of a run upwards. We saw a couple bad days here, but we're coming back up. But we have a lot of resistance ahead of us, guys. We've got the Fibonacci levels. We've got a 25-day moving average. We've got a 200-day moving average. We've got the 100-day moving average that are up against us that we're trying to pierce through. Those are all levels of resistance, kind of like running through a wall, right? We have to run through each of these walls to get better. But we have some good news coming through. Some good news on the 10-year that I want to focus on. So the 10-year, and I'm going to look at these stochastic charts. These are trends of the sale of bonds. Okay. If you look up here, we're at a high, we went up, and notice how this mountain corresponds to this mountain. And when the stochastic charts, and it was oversold, and when they dropped, the 10-year dropped. And then they came flat. They went up a little bit right here, and they went up a little here. See that? And then they went down, and it went down here. Well, we're up here now, which means they're oversold, and this should come down here. This 10-year should start to fall down in here. Now, if we have any bond-friendly news this week, we're going to see the 10-year drop. And then when the 10-year drops, mortgage rates drop. So this is going to be very good news. So we just really need some bond-friendly news this week with the jobs reports that are coming out with some inflation numbers. But if that can happen, we're going to see, we're going to be carefully floating here, and we're going to see, hopefully, this 10-year drop because of where we're at this stochastics, to drop back down into a more neutral zone. So what do we see for mortgage rates? I think we're going to see a little bit better, but we're going to carefully float, because if we get bad news with bond-friendly news, we get bad news for bonds, we could see it kind of hover in this little space here and just not do much of anything. But who can tell me, raise your or unmute yourself, who can tell me what the date is that we're getting the next CPI report? Who remembers?
May 10th.
Yes, that was loud. Sorry, I just clapped and it was really loud. Yes, May 10th. May 10th is the day that the new CPI comes out. And the reason that that's an important date is that's when the rear view mirror, the roller coaster that's behind us, is finally starting to catch up and get some speed down the hill. And that's when we're going to see the inflation numbers come back down. Now we have fuel. That's still a problem. I don't know if you've seen in Arizona, our fuel is about $1 more a gallon in the last month, partly because we now need more refined fuel, which we can only get from California and a few other places. So our gas is a little bit more expensive here. So locally, we're seeing a little bit of that inflation, but overall, nationally, that number should come down and help with mortgage bonds. So here's where we're at with mortgage rates. Well, I guess we don't want to look at 666 too close there, so we'll get by this slide pretty quickly here. But we are up higher. Last week when we did this report, the average was 6.5. There was a couple days where we slipped, and then we had a couple days where we came back up. So we should have a trend higher. This should drop this week. So we're going to be carefully floating, but rates have been in the sixes. They've been at least a little bit consistent. And that's what we haven't seen in a long time, consistency in rate. I mean, we went from 3 to 4, and borrowers saying, oh my gosh, rates are so high at 4, I'm going to wait. And then all of a sudden they are at 5, and the borrowers are like, oh my gosh, I'm going to wait some more. And then they were 6 and like, oh my gosh, I can't buy anymore. And then they got to 7 and said, well, screw this. And then they almost got to 8, right? So it's been crazy. Well, now they come down and they're hovering in the 7s. They dipped into the 5s for a moment there at the beginning of the year. And we think that we're going to get back into the 5s sometime in the near future. So if you're trying to buy a home, still buy, because you can refinance later. Remember, no lender fees on your refinance if you buy now and refi later, because we are starting to see a little bit more appreciation. So, and that's just this last month, we're starting to see multiple offers come on the good homes. You're starting to see a lot more people out there, and they've just given up on the fact that they just know rates are probably not going to be in the 2s, 3s, and 4s again. So they're getting back into the game. So that's a good thing. It's there's still a lot of hesitancy out there, especially with these new changes with loan level pricing adjustments. It's going to make people a little frustrated, but we have short memories. All right. People are okay now with 6s because they were in the 7s. It's just our psychology. That's just how it works. They've kind of given up on the fact that the 3s and 4s are out there. So here's what's happening this week to give you an idea. the news that's coming out this week. The most important things are the PCE, which is coming out on Friday. We have jobless claims, jobs Thursday. And then we've got some new home sales coming out, some Case-Shiller home price indices. It's going to be interesting to see. Consumer confidence. So a lot of activity this week, but notice nothing really happening today. So today's a pretty mellow day. Friday is going to be very active. PCE is going to be out, personal spending, personal income. We're going to see kind of the effects of maybe a potential the recession. Maybe it's starting to rear its ugly head and actually show signs of a weakened employment world, and that CPE, that inflation coming down. So Friday's going to be an important day for us. But that's basically it as far as what's going on with rates. I'm going to open this up to more of a conversation on what's happening with mortgage rates and with these loan level pricing adjustments. Does anyone have any questions on these loan level pricing adjustments and how that's going to be impacting mortgage rates?
Hey, Sean, it's Tara Riley.
Hey, Tara.
I typed a question in, but I can just ask it on here. So going back to your chart at the beginning, would a high credit borrower be better off making a 5% down payment instead of a 20% because of how that chart looks, where you have some of the green and the 5% versus the red and the 20%, and then they could always put that towards their principal after closing to get their PMI off faster? Are they better off doing that?
That's hard to say because it's going to be a lot of work that they have to put into doing that. What we can do is, you know how I use that mortgage coach presentation? If you guys haven't seen that, I put 4 different mortgage scenarios side by side. So what we're going to have to look at is that, in fact, okay, let's see if you put 20% down versus 5% down, what rate you're going to get. And let's see what you have to go through then to remove that mortgage insurance from the loan with a principal reduction and doing a loan recast, because that costs about it's usually about $300 to do a loan recast as well. So those of you that don't know, a loan recast is where you take a large principal, you apply that to your mortgage, and then you ask the mortgage company to then re-amortize the new balance to drop the payment. If you make a large sum payment just on your mortgage right now without asking for that, it'll just go towards your principal, but your payment will stay the same. You have to ask for that recast. So when you ask for that recast, if you do that in the future, there are some extra steps to try to get the mortgage insurance removed. So that could be a pain in the butt, and it may not be worth it to that borrower to have to go through that. So that's a personal question that we'll have to look into that. Or put it side by side to see if it's really worthwhile. Is it to subsidize the DPA program? No. So DPAs, down payment assistance programs, are hyper-local. There are some that are more national, but the only way to subsidize a DPA program is to have rates that are low enough where there's mortgage coupons that are high enough and there's a spread there to be able to give that money back to the consumer. So the way that the DPAs work is they give a much higher rate and they take the yield in that and they give that to the buyer to help them with their down payment. Well, right now we're at such an interest rate environment. Well, there's not much higher we can go. There's not mortgage coupons that are sold that are high enough to have that yield spread, which a lot of people know that term, to be able to give back. So that's why you see a lot of these down payment assistance programs. There's really nothing to them right now, which leads me to our Powerhouse 100. Don't forget, we have a 0 down loan, 100% financing. There's no need for a DPA for anyone, as long as you have a 720 credit score and as long as you have your debt to income ratio right around the low 40s. So don't forget to, yes, May 5th, we have a home buyer webinar. So it's monthlyhomebuyerwebinar.com is the domain name. monthlyhomebuyerwebinar.com. I'll put that in the chat right here. You can send your buyers to this. When they register, they have to put who their agent is, and it's an anonymous webinar. So it's not going to be like this where we see everyone's face. It's going to be just like, let's see, I'll show you what it's going to look like. It's just going to be me. just like this, right? Well, I don't know, you can't see this. You may not be able to see my screen, but it's going to be anonymous. So you're going to be able to see just me. No other people are on it. So if you do have a buyer you want to refer to it, they're not going to be mixed up with other borrowers or other realtors, and it's anonymous. So I just want to make sure you guys know that. It's great. We go over everything soup to nuts on what it takes to buy a home, some tricks, a lot of myths that we debunk. We go over everything, things to avoid when buying, how to shop for a loan, how to shop for a rate, everything. The process, it's really great. So monthlyhomebuyerwebinar.com. Yep, that's it. monthlyhomebuyerwebinar.com. So if you go to www.monthlyhomebuyerwebinar.com, every month we do them. It's the first Friday of every month at noon. So first Friday, I'm going to write that in here. First Friday of every month at noon. And you register at www.monthlyhomebuyerwebinar.com. And once you get the registration, you'll get the link. You'll be able to hop in there and